Hello viewers, welcome back. Have you ever wondered why the US dollar, which was worth around $3 in 1947, now cost over 88 in 2025? This huge change in the dollar rupee exchange rate reflects decades of economic shifts not only in India but globally. Today, we will explore the journey of the Indian rupee from being strong to facing depreciation against the US dollar. Understand the causes, key turning points, and what this means to us. Right after India gained independence in 1947, the Indian rupee was pegged to the British pound and then later to the US dollar. In 1947, 1 USD was valued at about 3.30 rupees. At that time, India's economy was largely controlled and trade restricted, inflation was low, and foreign exchange controls kept the currency stable but largely inflexible. Now, let's dive into why the rupee value declined over the decades. Trade deficits and imports. India imported more than it exported, especially oil, which is priced in USD. This created a constant demand for dollars, pushing the rupee down. Higher inflation in India. India's inflation rate were generally higher than those in the US. Inflation erodes purchasing power, so the rupee's price against the dollar naturally declines. Economic policies and controlled forex market. Until the 1990s, India had a fixed exchange rate regime. The government kept artificial control on the rupee's value, but in 1991, due to a balance of payments crisis, India liberalized its economy and moved to a market-determined exchange rate, leading to an immediate depreciation. And then global financial events. World events like oil prices, shocks in the 1970 and global economic crisis contributed to volatility. For example, the 1973 oil crisis increased import bills, further straining capital flows and FDI. Foreign direct investment inflows and outflows affected rupee demand. The rupee often weakened with sudden foreign portfolio withdrawals. US dollar strength. Internationally, the US dollar strengthened over long periods, partially due to the US economic size and roles as the world's reserve currency, which also affected the rupee's relatable value. Then let's come to the key milestones in exchange rate. 1947, 1 USD is equal to 3.30 rupees. In 1966, major devaluation took rupee to 7.5 per USD after economic pressures. 1991 economic liberalization and the balance of payments crisis led to 17.5 rupees per USD. In 2000s, slowly depreciated about 45 to 48 per USD around 2005 to 2010. In 2020s, near 75 to 80 per USD due to pandemic impact, inflation and global factors. So, what does this depreciation mean? Exports. A weaker rupee can make Indian exports cheaper and more competitive globally. Imports. It raises the cost of all imports, including crude oil, electronics, machinery. This impacts inflation and the cost of living. Foreign debt. Repaying foreign loans become more expensive for Indian companies and government. Investment. Currency volatility can affect investor confidence but also attract arbitrage opportunities. Then, what can be done and what are the precautions and future outlook? Government must focus on reducing trade deficits by boosting exports and cutting unnecessary imports. Monetary policy. RBI needs to control inflation while maintaining forex reserves. Economic growth and reforms. Strengthening manufacturing, Make in India, IT and services sectors ensures steady foreign exchange inflows. Diversification. Less dependence on oil imports through alternative energy helps stabilizing imports bill. People, investors should hedge currency risk and businesses need to factor forex rates in pricing strategy. The rupee's journey from 3.30 rupees to 88 against the dollar reflects India's dynamic economic growth, external pressures, and global market flux. Understanding these changes helps us make sense of the world economic's complexity. Whether you are an investor, student, or curious learner, keeping track of such currency or movements is crucial. Thanks for watching. Don't forget to like, comment, and subscribe for more financial insights.